TradeTheMBI.com. This is John. This report is for the 29th of September. And, well, we were expecting a return rally at some point, given the fact that we had seen DOC numbers in that were so far lower, down in that negative 20 space. Usually by 23, you get a much stronger kickback. This was pretty good. We came back up to what I was talking about would be the 0%, just a fraction over it, and then right back below, and you can see some of the trail off. So what caused all this? Well, of course, this was Bank of England move. They were facing a significant liquidation event, and there were billions in margin calls for their funds. The pension funds were over leveraged too much into their version of the treasuries, and it caused a real situation where they had to provide instant liquidity. And of course, this expectation was that the Fed will have to do the same, which is what the market had wanted to hear, and caused a knee-jerk reaction to the upside. And of course, a lot of short covering in that really propelled it. As you can see, we're already suffering a bit of a drawdown back into that already. And not surprising, because it fundamentally doesn't change anything. The Fed would have to change course, and relatively speaking, England's economy versus, just like, for instance, Italy's got a bigger economy than England at this particular stage. And so the overall effect, not as great as some would think. We saw effects of it too in the euro, took a major bounce, but already starting to give away most of that return that it took. And it's a function of this idea that these central banks can continue to manipulate back and forth um, how the markets react. And it's really nothing based in the economies, because at the end of the day, the interest rate rises that are still going to have impacts on actual growth and earnings. And the Fed is handicapped, even in the US, as to what it can do, because if it continues to go towards the rates that it's looking for, you're going to have an absolute meltdown in so many different areas that this idea of a soft landing is crazy. They're not going to get back to their 2% inflation goal anytime soon. And how crazy do you need to do it all at once? Well, if you're going to continue to spend at the rate they're spending, it doesn't help to have the inflation, because the whole point of the inflation is to devalue the dollar so that the debt is less expensive. But when you keep piling on even more as stimulus, it just has the reverse effect. So you've got the England is basically doing quantitative tightening and easing at the same time, tightening with the raising of rates, but then providing excess liquidity. It just makes no sense whatsoever. And the market's going to react to these situations. Gold took a giant bounce on that. Gold has got a lot more room to rise. However, again, we've talked about the split bifurcation, the fact that you're dealing with a lot of paper derivatives. It's hard to look at it more as a physical metal, as more or less just another paper product, which is an interesting aspect. And that's where I've always said that oil now moves more into that reality of being an actual commodity that really has a stronger force. Of course, you've bifurcated that market too now, where you're going to have the Eastern world versus the West version of it, how it's traded and or um, settled. And it's not always going to be in dollars any longer. That was a pretty decent spike back up, and no surprise, it was a slight crude draw. And again, even with the strategic reserve releasing record amounts, it's not enough to fill the void. Only a change in policy would do that, and doesn't seem imminent at any particular point. Bitcoin holding off that 18, moving up towards that 19 middle range. And of course, if it gets a little bit of momentum going back in there, it's kind of soft on that MBI magenta back and forth. A green continuation here would get it over cyan, which would indicate that buyers have really overtaken the liquidation pressures. And I think that's also going to be relative to market conditions. You would have thought with the giant rise in the market that you would have seen a bit stronger bid. But, this is the same situation with NFTs. All the other things have really struggled since the market lost that free money, and it's that free liquidity that was given to them that's no longer in existence has really put a damper on a lot of things. And we're going to continue to watch it, because I think real estate and those kind of areas really are going to reflect it, because that echoes through the economy in real terms for jobs. So from the 50K standpoint, you can see that it took the buys, sold them out right before the decline started, then took the new short on the dip intraday. Fantastic stuff. I mean, it started with a lot of little moves back and forth, and then we started to capture a little bit stronger breeze as the day went on. There was a lot of momentum with the short covering, and that really produced some decent buys. But again, I'm always looking at those positive extremes that start to develop within them, and they become relevant. As we can see in these different areas, they were all producing positive extremes, even going back into the previous area. And so that is just a matter of waiting for the proper signaling to develop. And whether it happens same day or within the next day or two, that doesn't really matter. The market, when the algos are operating this way, they're not really worried about time as much as they are about achieving the ultimate goals. And once you get that exuberance started, you just have to let it work its way through and just follow along with that momentum. And that momentum gave us some really decent buy configurations, as well as nice fillbacks. I don't have any objection with any of those. And from an intraday standpoint, things had flipped to the more positive, so I was looking to run the long side of areas a little bit further. And then when the short signals do come in, a little bit more cautious with the stops on them, just because we still had that momentum leaning the strong way. But then as we got towards the end of the day, we had peaked out with a few more sets of positive extremes. Going all the way back, we also had the dips below the red line that had been matched as well. And then you can see in post market here, the reality has set in that that you can only do these gimmicks for so long to have a certain effect. We knew that we were extremely oversold from a technical standpoint. There was a lot of move into the negative side, and whenever there's too great an imbalance, the market always loves to jump back and collect some of that from weak hands who will just be in and out and feel like they're getting whipsawed around. But this has all been pretty clean overall. So I think another exciting month. We expected September to have some wild rides. I think October is going to be really a defining one because you're going to have the election set up going in there. There's going to be a lot of nervousness. Probably see a lot of plays towards conservative moves. So we may see that take place as far as a rotation and away from some of the beta setups. I think it's been a wild year for a lot of different people. And now it'll be the fight to who performed the least worst as opposed to who performed the best. And that will affect our year end, which is, after October, the November election, we should start to see an attempt towards a bullish run. And if that's not successful, that's going to be really interesting because that's where we will start to get potential cascade effects and really start to people will focus on those numbers a bit harder as they see the real economy versus what the paper trade is. All in all, plenty of time to talk about all that stuff in the future. As always, though, I will continue to update you on Skype chat. Trade well.